Hey guys, what's up and welcome back to 10 Bagger Stocks, the YouTube channel where I document my personal investing journey. This channel is dedicated to creating a space where investors can share ideas, learn to earn, and most importantly, try to beat the street together. First of all, thank you so much to new subscribers and those who comment. It literally is an amazing feeling to create content and have a discourse through the internet. I'd also like to apologize that I haven't uploaded in like a week. I've been cracking a few cold ones with the boys, as you say, and let's just say I didn't get around to it. All right, so with that aside, today we're going to be talking about 4 mid-cap stocks that could be multi-baggers out of the next correction/recession, whatever you want to call it. In fact, we don't really know what to call it yet because a bull market has literally occurred again since the all-time lows of the S&P. Needless to say, what's happening in the markets is crazy and unprecedented. As much as we like to speculate what will happen, it's unpredictable, especially on a day-to-day. I mean, just look at Davey Day Trader, who claims that he's always on the wrong side of the market. Despite all that's occurring in the market, I do believe there are opportunities to find real value outside of the popular names and industries. I'm investing in the stocks discussed in this video even on green days, as I believe the long-term outlook of these stocks is positive. If they fall, I will just average down. So yeah, it's also important to note that I'm personally keeping about 10% of my portfolio in cash so I can jump on any opportunities when a stock tanks. I was keeping a ton of cash on the sidelines in February, not because I knew that the Rona was going to cause the market to do this, but just because I thought valuations were ridiculous and it was hard to find any real value. Not saying it wasn't out there, just saying I didn't have the skills or resources to find it. But all that being said, I got lucky by holding this cash because as soon as I saw Bill Ackman on CNBC talking about Armageddon, I knew that fear was hitting a maximum and it was time to start a position in some of the stocks that I had been researching. Before I get started on this video, I would just like to ask you guys to throw me a like if you're searching for value buys in today's market. And also, the like helps me get more views and with the YouTube algorithm and such. Okay, so sorry about that tangent, and I'll get back to the content of the video. What you are all watching this for, investing ideas. So the first mid-cap I want to discuss today is Spirit AeroSystems, ticker SPR. Spirit is a direct supplier of parts to Boeing, and they produce 70% of the body for the 737 MAX, which is sitting on the sidelines currently due to safety issues. The stock has taken a massive hit along with Boeing, but I believe that the selling of the stock is overblown considering a long-term horizon. The safety issues with the MAX are not related to parts that SPR produces, so it's unlikely that Boeing would simply just switch suppliers for 70% of the aircraft's body, which wasn't the piece of the plane that was defective. The future of the airline industry is somewhat relying on the success of the 737 MAX, as there was 4,000 back orders for the plane. Now, with the economy slowing down and everything, some of these orders are being canceled. But obviously, we're going to see good times again, and if the plane is to be successful, orders will shoot right back up. Boeing obviously needs to get their stuff together, but the company has definitely faced some unprecedented headwinds between the initial failure of the 737 MAX and this Rona crisis. I think that the majority of the U.S. investors would say that Boeing will make it out of the crisis and continue to be one of the most important exports in the world economy. When Boeing pulls it together, I believe that they will maintain their relationship with SPR, and SPR will continue to be an important supply chain member in the production of the most important plane of the next 10 years, the 737 MAX. What drew me to SPR was a very strong balance sheet and fundamentals, and they, even though they're very important with the 737 MAX and stand to make billions being a member of the supply chain of that plane, they actually have a pretty diversified business model and get income from different sources. So all in all, I mean, it could be a great value buy right now, and I think people are just really scared about the impact of the Rona and the 737 issue, which is affecting SPR's share price probably too much right now. All right, so moving on. The second mid-cap I want to discuss is called, actually this one's not going to be that popular with most people, but it's called Alliance Resources, ticker ARLP. This investment probably looks a little strange at first glance as it isn't in a very hot, popular, or growing industry, which are all things that I like to invest in. So ARLP mines and produces coals, operating mostly out of Kentucky. They are the third largest producer of coal in the United States. ARLP even exports a portion of their coal to China and Europe, and although Europe is making swift efforts to reduce coal consumption, being led by France, who intends to cut consumption fully by 2021, China is literally building coal plants right now. Not saying it's good, just saying that there will be a continued market for ARLP's product for at least 10-15 years. Although the trend of the United States energy system will be eventually phasing out coal and head more towards environmentally friendly means of electricity generation, coal still plays a major part in our energy grid. As of 2019, coal is the second highest producer of U.S. electricity, accounting for 23.5% of all the energy generated in the U.S. That's second only to natural gas, which is slightly more environmentally friendly than coal and is currently cheaper. I also have an investment in natural gas, which I will discuss in a future video and link in the description of this video. So if you want to get in on the future of natural gas, I have a stock for that. Although U.S. reliance on coal is on a downtrend, I do think it is unlikely to be completely phased out of not only the U.S. but the world energy grid anytime soon. I'm thinking coal will be a very safe investment considering the components of the worldwide energy grid over at maximum a 10-year horizon. The decrease in domestic popularity of the coal industry coupled with warmer winters and a trade war are definitely recent headwinds for ARLP. However, at current valuations, it presents a fantastic, almost unbelievable margin of safety. The company has a really strong balance sheet and fantastic numbers in the income and profit category, which allowed them to pay such a high dividend yield. I think it was like 8% before. Obviously, they cut it due to the coronavirus for a quarter, but it'll be back again. As of 2020, that yield has been cut, that's what I just said, and the company is focusing on mitigating the current environment. A very smart move for them, but one that forced a lot of selling of the stock because it was a portfolio favorite of many investors simply because of the dividend. I don't think ARLP is a great investment with a 50-year time horizon, as I have no delusions about the future of the coal industry. However, I do believe the company offers a fantastic value here and should be a multi-bagger after this difficult period when energy consumption and mining operations resume to normal levels. The company's income is literally almost the same as their market cap right now, and that's with coal prices underperforming. So if coal prices ever shoot back up, this is going to be a 10-bagger. And I don't know if that's realistic, but we're at least talking a 2-3 bagger here. The stock is priced as if coal consumption is literally going to stop within the next 2 years. It's also good to note that coal itself is cyclical, and even though the company is unlikely to go bankrupt from here, an increase in the price of coal would present tremendous upside in the stock. The stock price has fallen from $20 as recent to around $3, recent lows, and I don't think a forward-looking stabilization in the $6 to $12 range is unreasonable. Consider how efficiently the company is managed and the strength of their balance sheet. Because of the margin of safety presented at these levels, the worst-case scenario is that valuation will remain the same, and you would be collecting a very nice dividend off the stock at like 8%, 10%, something like that. This investment opportunity presented by ARLP reminds me of the words of one of my favorite investors, Monish Pabrai. Heads I win, tails I don't lose much. All right, beautiful. So the third mid-cap I want to discuss is a retailer, and it's Designer Brands, ticker DBI. DBI's main operation is shoe retailer DSW. They also have a few shoe brands themselves underneath the DBI umbrella. And obviously, I'm not personally a fan of shopping at DSW. However, my mom and grandma are, and I believe all their friends are. I believe that DSW is a strong candidate for a big rebound once consumer confidence returns. There are two reasons for this. DBI/DSW has been managed effectively and is one of the retail companies I see that has been consistently profitable, paying a dividend, and able to maintain a good balance sheet. As such, DSW is unlikely to take on unreasonable debt during this Rona shutdown and is highly unlikely to end up filing for bankruptcy. I also think that DSW has a decent moat for at least the next 10 years, as I think many people who shop for shoes like to go to the store and try them on first, especially those in the target market of DBI. I obviously can't argue that e-commerce isn't on the rise. It's Amazon is going to take everything over, obviously, but brick and mortar retail that holds on for. But I believe that shoes, especially for older women, would be one segment of the brick and mortar retail market that holds on for slightly longer. The growth story I'm presenting is obviously an opinion and somewhat anecdotal. However, their margin of safety presented by the fundamentals of this company, as well as the evidence of insider buying millions of shares worth at recent lows, tells me that DBI presents a really good value opportunity for the medium term at this current valuation. I'm thinking I'm in at an average of $5 and like 2 or 3 cents, something like that. I'm thinking that this is going to be at least a 3-bagger. Okay, so this is the 4th mid cap, and this is actually one that I haven't invested in yet, but I might be looking to leg in a position. I'm going to see how all this plays out. I need to look more into the company's debt. But anyway, so the company is Welbilt Industries, ticker WBT. WBT is the largest publicly traded company operating in the Tampa area, and they are part of a supply chain for restaurant components. They supply needed equipment for the restaurant industry like refrigerators, ovens, and fryers. The company has decent fundamentals, and again, insiders have been buying all the way down after this coronavirus. The company offers a PE of 13, which is decent, a PEG under 1, which is very good if you're a Lynch guy like me. But on the negative side, the company has tons of leverage, which is not a great position to be in currently. That being said, legendary investor Carl Icahn has WBT in his portfolio, which I actually noticed after I had already discovered and researched the stock. So I was a little proud of my discovery. You know what? I'm just I'm doing about as good as Carl Icahn. Nah, I know I'm not, but anyway, let's move on. Of course, this alone doesn't mean that the stock is a multi-bagger, but I think that it's a mid-cap that presents a very good future prospects and has been beat down quite a bit along with the rest of the restaurant industry due to, well, all restaurants being closed and possibly going out of business. But when we make an investment, we need to think, what is the outlook going to be in 5 to 10 years? I have a feeling that humans will still eat at restaurants plenty, and supply chains for which WT provides, which were considered to be valuable in the past years, will continue to be very valuable in the future. Coming out of a shutdown, I would like to see WBT become more efficient in turning earnings into income, and that will only be achieved by seeing how long the CV crisis plays out. WBT, like I said, WBT is the only stock in this video I haven't purchased any shares of yet, but will look to add it to my portfolio after another leg down in the market or once the dust settles on the crisis. I actually think another opportunity for the stock too that I didn't write here, but I'm going to just discuss off the top of my head, is that if a lot of businesses and restaurants go out of business due to the coronavirus, WBT and the new businesses, new restaurants open to take that market share, WBT has a great opportunity as a supply chain member to supply the new restaurant items to these new restaurants that are sprouting up. So perhaps as long as WBT can make it through the coronavirus, they actually are creating a brand new market of new restaurants to sell their goods to. I don't know if that's a fact. That's just a bull thesis that I have. All right, so I hope you guys really enjoyed the video. Please like, comment, and subscribe if you found the content valuable. I encourage anyone to join in the discussion by commenting down below, regardless of their investing experience. Again, guys, I really appreciate if you watched this long, but I really appreciate everyone that's been commenting and subscribing. You guys are literally amazing, and it makes me feel so good. So I'll see you guys on the next video, and until then, happy bagging, folks.